Let's now look at illustration number 12. A Limited has issued compulsorily convertible preference shares, also referred to as CCPS, compulsorily convertible preference shares at rupees 100 each. 10 is rupees is face value and rupees 90 is the premium per share. It has issued for 10 lakh rupees. All right. So the number of preference shares that it would have issued would have been 10,000 preference shares. All right. So 10,000 preference shares were issued at rupees 100 each. So the total consideration that was received was rupees 10 lakhs. These are convertible into equity shares at the end of 10 years, where the number of equity shares to be issued shall be determined based on the fair value per equity share to be determined at the time of conversion. All right. So the number of equity shares into which these preference shares will be convertible is not known. All right. The conversion ratio is not known. What we will do is that will be determined on the date of conversion. At the time of conversion, we will calculate what is the fair value per equity share. And depending on that, we will actually issue equity shares. Depending on the fair value per equity shares, the number of equity shares will be determined. For example, the total consideration that we have is rupees 10 lakhs. All right, hypothetically, let us say the fair value of the equity share on the date of conversion. Let us say the fair value of equity shares on the date of conversion is rupees 20. In that case, the number of equity shares to be issued will be 10 lakhs divided by 20, which is going to be equal to 50,000 equity shares. All right, so to actually convert 10,000 preference shares, we will be issuing 50,000 equity shares. The reason we are issuing more number of equity shares is because the fair value per equity share was only rupees 20. All right. So if the fair value on the date of conversion is rupees 20, to redeem this 10 lakhs, what we are going to do is it will get converted into 50,000 equity shares. If it is not 20, let us say instead of 20 on the date of conversion, the equity shares had a fair value of rupees 50. Assume that the equity share had a fair value of 50. In that case, the number of equity shares to be issued will be 20,000. The number of equity shares to be issued will actually be equal to 20,000. All right. So depending on the fair value of equity share on the date of conversion, we will determine the number of equity shares that the preference shares will get converted into. All right. So if the equity share fair value is 20, then these 10,000 preference shares will get converted into 50,000 equity shares. If the equity share value has a if the equity shares have a fair value of 50, then this 10,000 preference shares will be converted into 20,000 equity shares. So if you actually look at it, a Limited actually has an obligation to deliver a variable number of equity shares in future. All right, with regards to these preference shares, there is no information given about dividend. So let us assume that the dividend is 0%. So A Limited does not have an obligation to pay dividend. All right, dividend is 0%. I'm assuming that. So A Limited technically does not have an obligation to pay cash with respect to dividend. Now, with respect to principal, A Limited does not have an obligation to pay cash because they are compulsorily convertible. They're compulsorily convertible, meaning I will never actually give cash to these preference shareholders. They will compulsorily get converted into equity shares. But the question is, I do not know the number of equity shares that they are going to get converted into today. I do not know the number of equity shares that they are going to get converted into today. That will only be known at the end of the maturity. All right, at the end of, let's say, 10 years, over here with the maturity was 10 years, I will know the number of equity shares that are going to be issued only at the end of 10th year, because it is a function of the fair value at the end of 10th year. Whatever is the fair value of the equity share at the end of 10th year, depending on that, I will know the number of equity shares that I'm supposed to issue. Therefore, in this case, A Limited has got an obligation to deliver variable number of equity shares. It has an obligation to deliver variable number of equity shares. Why am I saying variable? Because the number of equity shares to be delivered can vary based on the fair value of the equity shares. If the equity share has a fair value of 20, the number of shares to be delivered will be 50,000. If it is 40, it will be 25,000. If it's 50, it's going to be 20,000. All right. So the number of shares to be delivered will keep varying. So A Limited has an obligation to deliver variable number of equity shares. In such cases where A Limited has an obligation to deliver variable number of equity shares, these compulsorily convertible preference shares, the 10 lakh rupees that we received on day one, the 10 lakhs that we have received today will actually be classified as a financial liability. All right. An obligation to deliver variable number of equity shares in future means that it is a financial liability. All right. So the journal entry for this is going to be bank account debit of 10 lakhs to financial liability of rupees 10 lakhs. I will be recognizing this as a financial liability in the books of accounts. I will be recognizing this as a financial liability in the books of accounts from today. All right. Today, I will actually not recognize this as equity. Although I know that I have an obligation to deliver equity shares in future, I will actually not recognize this as equity, and instead I will recognize this as a financial liability. Why do we recognize this as a financial liability? We'll actually look at it in a moment. But for now, what I want you to remember is an obligation to deliver a variable number of equity shares in future means that it's going to be regarded as a financial liability. All right, it'll be classified as a financial liability. So evaluate if this is a financial liability or equity. We have determined that it's a financial liability because the entity has got an obligation to deliver variable number of equity shares. It's going to vary depending on the fair value of the equity share on the date of conversion. Now, the second part of the question is, what if the conversion ratio was fixed at the time of issuing such preference shares? What if the conversion ratio was fixed at the time of issuing the preference shares? Let us say if the conversion ratio was fixed at the time of issuing the preference shares, which means today I'm issuing preference shares, I'm issuing these 10,000 preference shares. Today itself, I am saying that these preference shares will be converted based on 2:1 ratio, which means I will actually receive two equity shares for every one preference shares. A Limited will issue two equity shares for every one preference shares, which means today itself I know that A Limited will be issuing 20,000 equity shares at the end of 10th year. It's going to issue 20,000 equity shares at the end of 10th year. That is known today only at the time of issuance. In such a case, it's going to be considered as A Limited having an obligation to issue fixed number of equity shares in future. A Limited in this case has an obligation to issue a fixed number of equity shares in future because the conversion ratio is known as 2:1. When the conversion ratio is known, I know the number of equity shares that A Limited has to actually issue, and therefore this is going to be regarded as an obligation to deliver a fixed number of equity shares. And an obligation to deliver a fixed number of equity shares means that the compulsorily convertible preference shares will be classified as equity right from day one. They will be classified as equity right from today itself. Now, so in this case where the conversion ratio is fixed, the journal entry would be bank account debit of 10 lakhs to equity of 10 lakh rupees. All right, it will be classified as equity right from day one if the conversion ratio is fixed. All right, so an obligation to deliver a fixed number of equity shares means that it is equity. An obligation to deliver variable number of equity shares means it is a financial liability. Now, let us actually try to understand the reason why it's classified as a financial liability when there is an obligation to deliver variable number of equity shares, and why is it classified as equity when there is an obligation to deliver a fixed number of equity shares. All right. One of the characteristics of equity is that it is actually residual interest in an entity. All right. One of the characteristics of equity is that it entitles the shareholders to residual net assets in an entity, which means whatever net assets are left after all obligations are paid, that those net assets basically belong to equity shareholders. All right. So they are actually supposed to be exposed to volatility in net assets. Equity shareholders, for something to be classified as equity, they must be exposed to the volatility of change in net assets. If your net assets increase, they should actually be benefiting the equity shareholders. If net assets actually reduce, they should actually result in a loss to equity shareholders. All right. So if you make massive amounts of profits, equity shareholders are supposed to enjoy those profits. If you make massive amount of losses, the equity shareholders are supposed to take the brunt of those losses. All right. So one of the characteristics of equity is that it is basically going to result in a exposure to the residual net assets of an entity. All right, equity shareholders, one, they do not have any obligation. An entity does not have any obligation to pay cash to the equity shareholders. That is one characteristic. The second characteristic is that the entity or the equity shareholders should be exposed to the variability in net assets of an entity. All right, if their net assets actually increase, they should actually gain as a result of such increase in net assets. If the net assets decrease, they are supposed to actually have a loss as a result of decrease in net assets. They must be exposed to profits and losses. They must be exposed to gains and losses of the operations of the entity that it is carrying on. Now, if you look at the first part of the question, where an entity has an obligation to deliver a variable number of equity shares. If you look at the first part of the question, in that case, A Limited had an obligation to deliver variable number of equity shares. For example, let us say case 1. I said that if the fair value of the equity share was equal to rupees 20, all right, I said if the fair value was equal to rupees 20, then the number of equity shares that the entity would issue, is actually equal to rupees 10 lakhs divided by rupees 20, which was equal to 50,000. All right, so in this case, A Limited was issuing 50,000 equity shares. Let us say in case 2, I'm taking, let's say the fair value of the equity share was, let's say, rupees 5. I'm assuming that the fair value of the equity share has fallen significantly and the fair value is only 5. In this case, the number of equity shares that the entity will actually issue, will be 10 lakhs divided by 5, that is going to be equal to 2 lakhs equity shares. All right, it's going to be equal to 2 lakhs equity shares. Case 3, we also took a case where fair value is equal to rupees 50. We took a case where fair value is actually equal to rupees 50, and in that case we had the number of equity shares to be issued as 20,000. The number of equity shares to be issued was equal to 20,000. If you notice in all the three cases, from a holder's perspective, think of it from a holder's perspective, irrespective of what the share price is in the market, irrespective of whether the share price is 20 or whether the share price is 5 or whether the share price is 50, the holder is always receiving 10 lakh rupees only. The holder is always receiving 10 lakh rupees because when the share price falls significantly to 5 rupees, the holder is receiving 2 lakh shares. They're receiving more shares in such a way that the amount is actually still 10 lakhs. When the fair value is actually 50, if the share price increases to 50, still the holder actually receives 10 lakhs only because the number of shares is reducing. All right, from a holder's perspective, whatever be the share price, the holder is actually always receiving 10 lakh rupees. All right, if the share price goes up, they're receiving the holder is receiving lower number of equity shares. If the share price falls significantly, the holder is actually receiving higher number of equity shares in such a way that he is always receiving 10 lakh rupees only. All right. And remember, I said one of the characteristics of equity is that they must be exposed to the profits and losses that an entity makes. All right. Remember, if the share price is actually falling badly down to 5 rupees, it means that the entity might have actually made significant losses. All right. Is this holder participating in the losses? The answer is no, because he is still receiving 10 lakhs. He's still receiving 10 lakhs. So he's actually not participating in the losses of the company. Same way, let us say if the company's profits zoom and the fair value goes up to 50, this holder is still receiving 10 lakhs because he's receiving lesser number of equity shares. Therefore, he's neither participating in profits nor is he participating in the losses made by the company. All right, from the date of issuance until the end of 10th year, all right, from the date of issuance until the end of 10th year, the company may be actually having significant gains or losses. The fair value might keep moving up and down, but this preference shareholder is actually not participating in the gains and losses from today until the end of 10th year, because at the end of 10th year, whatever be the fair value, however the company actually performs during this period of 10 years, he is actually at the end of 10th year going to receive 10 lakh rupees worth of shares. If the share price crashes also, he's going to receive 10 lakhs. If the share price goes up also, he's actually receiving 10 lakhs, which means that he is not participating in the profits or losses of the company. The preference shareholder is not participating in the profits or losses of the company from today until the end of 10th year, because at the end of 10th year, whatever be the value, he is going to receive 10 lakh rupees only. All right. Therefore, because they are actually not exposed to the variability in net assets, we are saying that these preference shares will be classified as a liability. They do not meet the characteristic of equity, and therefore they are going to be classified as a financial liability. Although the company does not have an obligation to pay cash, it does not meet the second important characteristic of equity, which is participation in the profits and losses of the company, and therefore we will actually classify these preference shares as a financial liability. The journal entry will be bank account debit to financial liability, where an entity has an obligation to issue variable number of equity shares, and where the variable number of equity shares is stemming from as a result of changes and fluctuation of fair value per share, which means as the fair value changes of the share, you will actually change the number of equity shares to be issued. In such a case, we are going to classify the preference shares over here as a financial liability until the end of 10th year. All right, until the end of 10th year, this will be classified as a financial liability. Obviously, at the end of 10th year, when the liabilities, when the shares are actually issued, let us say the preference shares at the end of 10th year, the shares are actually issued. Let us say we end up issuing 20,000 equity shares. What we will actually do at that point is we will debit financial liability of 10 lakhs. We will be debiting financial liability of 10 lakhs, and we will be recording equity share capital and share premium on that date. We will be recording equity share capital as 20,000 multiplied by rupees 10, which is the face value, and the remaining 20,000 multiplied by 40 will be considered as share premium. The sum total of this will also be equal to 10 lakh rupees only. All right. This is an example where I've assumed that the number of shares we are issuing is 20,000. If the number of shares that we are issuing changes, then the amount of share capital and share premium will also undergo a change. All right. So this will be the journal entry at the end of 10th year. All right. So until the end of 10th year, we are going to actually record this amount as 10 as a financial liability. And at the end of 10th year, when we are actually issuing equity shares, I will then de-recognize the financial liability and recognize equity share capital and share premium. All right. So this is going to be the journal entry where the company A Limited is obligated to issue a variable number of equity shares. Let's look at what if the conversion ratio was fixed. If the conversion ratio is fixed, remember, irrespective of what the share price is in the market, these preference shareholders will always receive only 20,000 equity shares. All right, these preference shareholders will always receive 20,000 equity shares, assuming that the conversion ratio is fixed at 2 is to 1. Now, if the conversion ratio is fixed at 2 is to 1, remember, if the fair value is 20, then the amount that they're actually receiving is 20,000 equity shares multiplied by rupees 20, which is equal to 4 lakhs. All right. They're only receiving 4 lakhs worth of equity shares. The conversion ratio was fixed at the time of issuance. And because the fair value is only rupees 20, they are going to receive 4 lakh rupees equivalent value. If let us say the fair value is 5, they are actually going to receive 20,000 equity shares of 5 rupees each, then which means that they are only receiving 1 lakh rupees worth of equity shares. All right. They gave 10 lakhs today, but they're only receiving 1 lakh rupees worth of equity shares at the end of 10th year. If the fair value is 50, then it's going to be 20,000 multiplied by 50, which is equal to 10 lakhs. All right. So if the fair value is equal to 50, they're going to receive 10 lakhs worth of equity shares. Now, if you clearly see over here, if the company's performance was poor, the fair value would fall down to rupees 5, and the amount that they are receiving at the end of 10th year is also significantly falling. They gave 10 lakhs today, but they're only receiving 1 lakh worth of shares at the end of 10th year because the company's performance was actually poor. If the fair value actually goes up, let's say to 50 rupees, then they're actually receiving 10 lakh rupees worth of equity shares. If the fair value goes up to 100, then they will be receiving 20 lakh rupees worth of equity shares. The number of equity shares remains constant, and they they are actually exposed to variability as a result of profits or losses that a company is making. All right, if the company makes losses and the fair value reduces to 5 rupees, then they are actually incurring a loss of 9 lakhs. They gave 10 lakhs, but they're only receiving 1 lakh worth of equity shares. If the fair value, let's say, goes up to 100, then the worth of equity shares that they will receive will be 20 lakhs. They gave 10 lakhs and only are receiving 20 lakh rupees, which means in case the conversion ratio is fixed, then the preference shareholders are exposed to the performance of the company. They are enjoying if the company is making profits, they are actually bearing the losses if the company is performing poorly. Therefore, where the conversion ratio is fixed, it means that the preference shareholders are exposed to equity. They're exposed, or they have the nature of equity characteristic from the date of issuance itself. If the conversion ratio is fixed on the date of issuance, then it means that the preference shareholders are exposed to the variability in net assets from the date of issuance itself. All right. If the company does well from today to end of 10th year, the preference shareholders actually enjoy the gain. If the company performs poorly, then the preference shareholders are actually going to incur losses. Therefore, on the date of issuance itself, if the conversion ratio is fixed, where an entity has an obligation to issue fixed number of equity shares, it shall be classified as equity. The preference shares shall be classified as equity. The journal entry for which will be bank account debit to equity of 10 lakh rupees. So that is the principle. Obligation to issue variable number of equity shares is a financial liability. Obligation to issue a fixed number of equity shares is a equity instrument itself. All right. So with that, we're done with illustration number 12. Also, just as a passerby reference, the logic that I gave you with regards to equity being exposed to residual net assets, that's not what the institute material says, although that is how you're actually supposed to read it. Over here, what the institute is saying is where the number of equity shares is actually varying, it basically means that you're actually you're using your equity shares as a currency. All right, basically based on the fair value of the equity share, you're using the equity share as a currency. If the value of the equity share is less, you issue more number of equity shares. If the value is high, you issue less number of equity shares. So you're actually using your equity shares as a currency to settle the obligation, and therefore any obligation to deliver a currency will be regarded as a financial liability. That is an alternative way of looking at it. All right, the correct way of looking at it is exposure to residual net assets, but an alternative way of looking at it is where you're actually issuing these equity shares as a currency. You're using the equity shares as a currency by whenever the fair value changes, you're actually changing the number of notes that you're supposed to issue. All right, let us say if you're issuing notes of rupees 20, you issue 50,000 notes, or where you're actually having 50 rupee note, you're actually issuing 20,000 equity shares, and therefore you're using equity shares over here as a currency wherein you're increasing or decreasing the number of notes that you have to actually use to settle, and that will be regarded as a financial liability. All right, that's how the institute actually answers it as well. With that, we are done with illustration number 12.